we're going to talk about the retail ugliness that is happening right now, and we saw this coming last week when Home Depot put up an amazing, stellar quarter, and the stock dropped anyway. And now we've got retailers putting up less than stellar quarters and just getting punished for it. And we'll start with Target. Third quarter results coming in below expectations, and you can look at what Target is doing in terms of their investment in the supply chain and think, well, long term, that makes sense, and I applaud that. And that's fine. But in the short term, that just means that Target's costs are going higher. Stock down 9% this morning.
Yeah, the stock going into today was up 22% for the year and up 37% from this time last year. So let's pull that apart a little bit. One thing that sort of allowed that was the stock being beaten up as much as it was. There was a lot of frustration with retail going into last summer, 2017, and a lot of stocks in the retail space really bottomed around then. So looking at it from that point, everything is going much better. They haven't been destroyed as of yet by Amazon, but Target's numbers show what the cost of that non-destruction is, and they had comps of 5.3%, which is pretty good. But there are costs associated with meeting customers in all the places they want to be, and Target's investments in sort of order online, pick up in the store, or pick up at curbside. These are good things for the customer, things the customer wants, but they are not easy to deliver without raising your costs. Either you're going to have to raise your prices, which is not particularly viable in as competitive a retail environment as we have today, or you're going to take on those costs and see your margins contract, and that's where Target is today.
Brian Cornell, the CEO, was very clear that despite the higher costs in the third quarter, he has a great deal of confidence going into the holiday quarter, not just in terms of consumer spending, but in terms of Target's ability to deliver on that. So I think if you're a Target shareholder, I think Brian Cornell has rightfully earned the confidence of the shareholders, given his track record there. So I think you're hopefully taking some solace in Cornell's confidence.
I do, and what I take less confidence in is how you construct the numbers in a way that makes it a truly exciting investment opportunity. That is, if traditional retail, let's go back a few years where you're going to get your comps of mid-single digits at a well-run place, and then you're going to open up more stores. So your total sales are going to rise maybe in the low double digits. Because you're opening more stores, you're getting bigger, your margins are going to improve by a little bit, and then you're going to buy back some shares. And when you combine all that and get down to the bottom line, you've got growth of earnings per share, hopefully in something like the mid double digits, teens, 15%, if you do everything right. And quarters are going to not always go right, but that's kind of the game plan. Well, now, are you really building more stores? And if you're not building more stores, are you going to see your margins improve because you're not really growing more than maybe the rate of the economy? If that's the case, you still might be able to buy back your shares, and Target did a bit of that over the quarter, but really they were buying them back at what appears now to be higher prices than they go for after today. So maybe they'll buy back more shares at a lower price over the coming quarter. But if you start getting at where are the comps, and that is kind of the main number that is going to determine your rate of growth, well, you're talking mid-single digits.